How do you invest in a recession? I'm glad you asked. Not financial advice, but in a recession, your goal should be both income preservation as well as wealth preservation. What does this mean? Well, it means you need to have income preservation so that, well, you can have an income to put food on your table. And we'll talk about that on a different video. But in this video, we're going to be talking about wealth preservation, which basically means you want to be able to maintain your savings and your investments. So if you do own stocks or real estate during a recession, it's likely that the value of these assets can go down substantially. We've actually seen that happen time and time again in prior recessions. So how can you maintain your net worth? There are numerous things you can think about, but first consider hitting that like button, and also be sure to subscribe to this channel if you do find content like this helpful. Help me help you. Now, one thing you might want to consider as far as stocks are concerned is moving away from high multiple stocks. And what I mean by that is stocks that tend to have a higher price to earnings ratio. If you've noticed so far this year, the NASDAQ is down substantially more than the S&P 500. Why do you think that is? Well, it's because the NASDAQ is comprised of a lot of growth and technology stocks, which tend to have much higher multiples or much higher PE ratios than other stocks you might find in the S&P 500. And so what happens in a recession is these tech stocks or these growth stocks with these substantial PE ratios tend to compress a lot more than something like value stocks, which have a lower PE ratio. You see, tech stocks have a lot of optimism. So people try to price in, or people try to forecast their future revenues. And so the price to earnings has gotten way out of control over time. You know, we're looking at 100, 200 PE ratios. So typically during a recession, we see that most people tend to opt for value stocks rather than growth stocks because, well, their PE ratios trade closer to realistic expectations, if you will. So one thing you might want to consider is rotating out of growth stocks into value stocks. One other strategy, since we talked about income preservation as well, is rotating into dividend paying stocks. I have a whole video on dividend aristocrat stocks right here, so be sure to check that out. It goes into why many people choose to have a dividend portfolio strategy and why they choose these particular stocks as a reliable source of income to live off of. But basically the gist of it is, if you have a stock portfolio that goes down in value, but you know, predominantly your stock portfolio is dividend paying stocks, then, well, who really cares if the market plummets, right? You still get that reliable source of income. So you're still able to survive off of that income in addition to whatever it is you do, whether it's your day job or business or what have you. As an alternative to dividend paying stocks, bonds are also a great option. Now, I'm not just talking about those laughable 2% or less yield bonds. I'm actually talking about inflation adjusted bonds. But Harris, inflation is over 7%. There's no way in hell that a bond would pay that much. Actually, there is, and they're called I bonds. And the I stands for, well, inflation. I have a short video on these 7% yield bonds right here, so be sure to check that out as well. And I also have a short tutorial step-by-step on how you can go and buy $10,000 worth of these bonds for a 7.12% guaranteed return on your investment. Be sure to check it out. Now, for most of you watching this, honestly, your time is probably better spent just focusing more on your career rather than what's happening in the stock market. So really, the good old strategy of dollar cost averaging is probably the best way to invest even in a recession. You see, the market is always right. So whether the S&P 500 is $5,000 or whether it's $3,000, it is what it is. Just keep continuing to buy, continue to dollar cost average, whether you put in $100 a month or $1,000 a month or $10,000 a month, whatever the case is, keep buying it so that you can average down on your cost basis. It's never been easier to do this than it is now because of fractional shares. I can go in and buy $100 worth of any share I want, regardless of the stock price, in something like a Fidelity brokerage account. And I have a video on exactly that right here, so be sure to check that out. But of course, feel free to use any other brokerage that you prefer. Moving on. Now, the one thing I wanted to mention is that historically, we know that cash devalues over time, especially when there's inflation. That's exactly what inflation is. It's the dollar devaluing. And let's be honest, historically, holding cash has been probably one of the dumbest things you could have done. I actually I have a video right here on how I lost $17,000 by putting my money in a savings account. However, in a recessionary environment, right, cash might devalue because of inflation, but assets like stocks or real estate, they might devalue more than the dollar depreciates, if that makes sense, right? So in theory, holding cash might work out in your favor because it might give you the upper edge to buy the dip when the opportunity presents itself. So basically, there are a ton of ways you could come out ahead in a recession, be it buying stocks, buying bonds, dollar cost averaging, or even just sitting on cash, believe it or not. But of course, investing alone isn't everything. So be sure to check out my other video on how to prepare for a recession. Thanks for watching.